Hi guys, is your put credit spread is in trouble? It's deep in the money and you wanna know how you can save that trade, or if you have some profit and you wanna see how you can lock in that profit, then you are in the right video. We are going to discuss how you can properly manage your put credit spread trade. So without any further ado, let's get started. Hello guys, this is Abhi and welcome back to my channel. This is a new channel, so if you are new to this channel, then please consider subscribing. There's a lot of option related videos I'm planning to make, and if you don't want to miss it, please do subscribe. Okay, let's get started with the topic of today. So today we are going to discuss how you can manage your trade. We have a full agenda. We are going to first discuss quickly what a put credit spread is. Second, we are going to see when you should or what is the best time to close a put credit spread, how you can manage the put credit spread if you are out of the money, if you are at the money, or if you are in the money. We will break down each of them and discuss it separately, how you can do it in each different scenarios. And the final thing is we are going to go in Robinhood, and along the way as well we will keep going back and forth between Robinhood and the slides, and finally we'll do a complete walkthrough of how you can manage this trade in Robinhood. Okay, so what is put credit spread, right? You may already know this, but I'm just going to give a quick overview so you are clear or just get a revision out of it. So a put credit spread is considered a bullish strategy that is made up of two option legs. A, you sell a put below the current stock price of the stock, and then B, you buy back a put which is below the strike price of the selling a put. So you sell a put which is closer to the stock price, and then you buy a put which is below your sell strike price, right? So that's create a spread. So to open this spread, you collect a premium. Let's understand quickly the profit and loss. How does it look for the put credit spread, right? So as you can see, in put credit spread, both your max profit and your max loss both are capped, right? And this is your short strike, which I said you sell a put, right? So this is that strike, and this is the strike that you buy a put, right? So between these, your profit and the loss both are capped, and to open this you get a premium back. So this is considered a very good strategy for a small account to grow a small account quickly, because you don't require that much capital. Like if you want to open just, let's say, just a cash secured put, right, you need to have that much cash capital. But in case of put credit spread, or also called as bull put spread, right, you don't need that much capital. All you need is the difference between the two strike prices multiplied by 100. So if you, let's say, open 170 and 160, you just need $1,000 instead of the whole amount that you would otherwise require to own the 100 shares of the stock. So that was the profit and loss. Let's now move it to a concrete example. I'll just take an example of Apple stock and just understand how a put credit spread would look like in a real world scenario, right? So let's say the Apple is currently going at $175, right? So the put credit spread you would open, you would basically sell a put at 170, which is 5 strikes down from the current market price, and then you would buy back a put at 165, for example, right? So this creates a $500 spread, the credit spread, and for which you are going to receive a premium of this is just an example, you receive a premium of $35, right? And the expiration date is a week, I think 2 weeks. So this is, I'm recording on a Monday, so it is still 2 weeks out in the future, right? This is just an example for expiry date. And the collateral, like I discussed, that would be the difference between 170 and 165. So a difference of that multiplied by 100 becomes the 500 is the collateral required. So this is your max that you need to put for this trade. And your max loss, if you say max loss, would be this minus 35, right? So that would be your max loss. So far, if you are good, then now we are going to go to the crux of this video, which is basically how you can save this trade if it is gone against you, or if you have some profit, how do you lock in that profit, right? So first we are going to discuss the profit scenarios, which are basically if the trade is out of the money or at the money. And then at the last we are going to discuss if your trade is in the money, and that's the situation where you have to do something to save that trade. Okay, so for the first one is the out of the money example, right? So the considering the same example that we did, which is this one. This is the current position. For example, you have it open, right? You opened it on 821 with expiry of 9/1, and this is what you opened as a put credit spread, right? Now let's say it is today is 2 weeks gone, and you are on September 1st, right? And this is the situation. The Apple price has gone up to $180. Okay, so in this case your position would be considered out of the money, because it is out of the money from both your strike prices 170 and 165. This is far out in the money, and this is the very favorable position. This means the trade has gone in your favor. The current premium uh, could be like maybe $1-2, or anything. You would have already achieved almost 98% of that premium that you got, right? If you had received $35, now to close this trade you have to just pay $2 and close it, so that would become like a $33 profit that you would make on this trade. So in this case you have two options, right? Either you let the contract expire worthless. In that case you collect the full $35 premium that you had received, right? So that is one option. However, my recommendation is that you basically close the position, any spread kind of position, right? There's always a risk of early assignment in any scenario on the shorter leg. So it's always best that if you have already gotten 80 to 90% profit, right, on a spread position, it's good practice to just close it early. So in this case, like going back to this example, right, if it is September 1st, and if you have already gotten like 98% of the profit, right, you just pay $2 and just close that spread, so you would be good to lock in that profit. And this is how you lock in your put credit spread early, right? You pay the remaining premium and you just buy back or completely close that spread. Now let's move to the second case where it is at the money, right? So at the money example, it's very similar. I'm going to take the same example, right, which you had open. The only difference now is that your current price of Apple is at 171, right, which is pretty close to your strike price. It is not hitting the strike price yet, but it is very close to your strike price, the short leg strike price, right? So this is considered at the money position, and this is in this case you could be, your premium could be still, you may be getting some profit but not like a out of the money scenario, right? So now let's look at what are the options you have in this case and what you should ideally do. Okay, so the first option that you have is you close the position early. Okay, this is the best option that you have in this case, because remember, you already have a profit of could be 30%, 40%, but it is always best that if the position is already at the money, that means anytime it could go in the money, and you would have a hard time then adjusting that position, which we are going to discuss next. But if it is at the money and you have got some value from your theta decay, right, then just close the position with, you will still get some profit out of it. It may not be same as the out of the money, but you will get some. So close the options early. The other option is you can roll out the position. If you think that this is just a temporary slowdown in the stock price and you have a good conviction that it could move back higher, then the other option is you just roll out the position. Okay, we will take an example later on how you can roll out the position. Is rolling out is in very brief, it is the opposite of how you opened it, right? So to open, you sold a put and then you buy back a put. You just do a reverse of that and you roll it out either to further down in the strike price, or you can roll it out to a future expiry. In both cases you may be getting a credit back, but the important thing here is use this option only if you have a conviction that the stock would go up in coming, let's say, couple of weeks time. Otherwise the best option would be to close the position early. The biggest mistake that you could do if your position is at the money is not closing and leaving it as. That is the biggest mistake, and this is a complete no because if it is at the money and you just let it ride till the expiry, there is a high chance that it could get assignment on the selling side and you would be in a trouble. So never keep the options legs open. By the way guys, if you have liked the video so far, please do like, subscribe to the channel. It's a new channel and I would really appreciate if you give a thumbs up, and that motivates me to make more such videos. Okay, going back to the topic. Now let's move into the in the money example, and this is what I want to put more focus, because in this case you are already in a losing trade, and you will have to see how you can save what you can save, or what you can actually do in this case, right? So let's first take an example and see what is called in the money, right? So I'm again going to take the same example here, the same setup which you had opened, but now in this case what is happened is the Apple price has dropped to 164, right? So Apple has really dropped because of numerous reason, or it could be anything. The Apple price has dropped and now your position is below your the strike price, right, which is the buyback strike price. It is gone below that, and now this is called in the money because your current stock price is less than the both the strike prices. So it is called in the money, and in this case your premium to close this option would have gone up. This is just a number, but to close this trade you will have to pay more than what you collected. It could be close to almost your spread width. This is just a number I have taken, but it would be you can be very sure that you will be losing some money out of it. I'll explain you later on how you can save some of that, but you definitely have to pay more than what you received. Let's see how we can adjust this position to save whatever we can. So the first option is closing the position completely. This you can do if you have a conviction that your trade is completely gone opposite, and you are not expecting it to go back up in any time in the future. Then it's best that you just take the loss and close the position. It is not worth trying to save a losing trade and which you don't have any conviction. The second option is you can roll out the position to a future date to expiry, right? So do this if you have a conviction that your stock will move back up, and in that case you can consider rolling out the position. I'll give an example in Robinhood how you can do it. The third option is you can roll it out to a future date as well as lower down your strike, right? So if you expect the stock to go down further, then what you can do is you can roll out your strike. So instead of, let's say, you opened for 170 and 165, right, you further roll it down to 165. You can do like a sell a put and then you go down to 160, right? So that gives you more room for on the downside, and the stocks, it gives time to recover back. The last option is this is also to just to save the trade. What you can do is so as you know, the put credit spread has two legs, right? It has a short put and then it has a long put, right? So you buy back the short put, okay? So that basically, and then let that other buy put ride. So in this case you are basically reducing your max loss, right? Like if I take an example, right, you sold a put for, say for example, 170 strike, and you, for selling a put, you usually receive a credit, right? So you received a credit of, let's say 130, and then you buy a put, right? You buy a put at 165, and for this, when you buy a put, you pay a premium, right? So you paid a premium of for example, like you paid 50, right? So the difference of is what is your premium on total that you had received to start this trade, right? So that is like $80 you had received as a premium. Now in this case, what you can do is you can close the sell put. You just buy back this put. To buy back, you have to pay back whatever you had received. So you pay back the 130, and then let this the second one buy put ride. Okay, so that is another option you can do. What it will do is it is basically you are protecting your collateral so that you don't lose the complete collateral. Plus, if you expect that the stock would go further down in the money, then you have this buy put left, and if it really goes down, then you have an unlimited profit potential as well. Okay, now let's take a quick example on the Robinhood, and I'm going to cover all the options in a single walkthrough. If your position was out of the money, at the money, or in the money, I'm going to just take one example and explain you all the situation, how you can adjust it. So this is a Apple spread that I have opened right now, and you can see this is a $250 spread. So basically I sold a put at 170, right? You can see I sold a put 170, and then I bought back a put at 167.5, right? So that's a $250 spread that I have opened, and for this I received a premium of I think it was 27, right? So I received a premium of 27. The expiry is 9/1. Okay, right now there is at this moment there is a loss of $9 that you can see here, right? So now let's understand the situations which we discussed. So on 9/1, on or before 9/1, right? If I see that this total return has a positive value of around 80% or something, then like we discussed, you can always go here. In Robinhood, it is pretty straightforward to close. You can just close this trade. You can right now you have to pay, right? Because it's still not 9/1. The theta decay has not played its role, and the Apple is hovering around that range. But otherwise, if it is out of the money, then your bid and ask here would be around close to like $1, $2 if it is gone in your favor, right? If the Apple is around $180 on 9/1, then you will see this bid ask as $1 or $2, and you can just pay that and close that. Okay, so that's out of the money. Now let's come to the at the money. So in at the money case, what could happen is on 9/1 the Apple could still be 171, right? In that case, instead of $1 or $2 to close, you may have to put like 25, right? You may have to put $25 as a cost to pay that trade. Okay, on 9/1, this is I'm just taking an hypothetical example for at the money. So in at the money case, if it is 9/1 and Apple is hovering around like 171, which is right at the my strike price, then it's almost at the end, and you would still be making like a 40-50% gain on this. The second option is you can always roll it out. Okay, so let's see how you can roll out a trade. I have a separate video. I'll just put a link down in the description or somewhere up on the screen, so you can go and check out the detailed video on how you can roll it out. However, just for this video, I'm just going to show it very quickly how you can do it. Okay, so to roll it out, what you can do is you click on this view all options. Now you go back to the expiry, and then you would actually see those here. So this is the short leg, right? So you sold a put here, so you do a reverse. You buy a put, okay, and then you sell a put. Okay, so this is the reverse of that, and you can change the expiry. So instead of September 1st, you go to September 8th. Okay, and then here what you do is, so this is basically closing the previous order, and now you can either roll it down. So you can go, let's say, instead of or you can keep the strike price same, right? You sell a put again at 170 and then you buy back a put at 167.5, right? So this is the overall trade, right? And for this one, as you can see, you are receiving a total credit of 7. So all you did in this is you are basically closing the previous put credit spread. You bought it again, we bought it, you sold this, and then you bought it again but with a different expiry, okay? And then you bought it back again on that 9/8 expiry. So you are basically moving your expiry date a week ahead and then rolling it out for a credit. So this gives one more week to you for Apple to kind of recover and go out of the money. So this is how you roll out the option. The other option is you can do it in two steps. You can close that previous one and then you open this same put credit spread again, or you can do it in one single order like this. Okay, both options are open. So that was about at the money or how you can roll it out. Now let's discuss the last option that we saw, right? Which was basically you buy back the short leg and you let the long put option right till the expiration, right? So in that case, if let's say both, let's say the Apple is 164, right? Like we discussed, and it is in the money. So what you can do is in that case, you buy back this one. So to buy back, you basically buy this one, you pay $92 and you buy back this put, and you just leave this one alone, okay? For this one, because this is you originally bought it, right? So you just leave it alone. So you buy back this one, so that will reduce your max loss, because now you are not open to unlimited kind of risk where you have to own or you have to force to buy 100 shares of Apple. So you just close your short leg and you let the long one ride. So this could, the long one could be profitable only in case Apple really drops, right? It's like some catastrophe happen and Apple really drops. You still have a chance to make unlimited profit if you just let this thing open. So the last option, like we discussed, right, you can simply close this complete trade. If you think that it is not going according to your plan, then you can close it anytime before the expiry. You don't have to wait till 9/1. You can close this anytime before that. You just pay back the premium and maybe some extra cost, and you just close that trade anytime before that, right? This is applies if you don't think that Apple is going to recover and you just want to get out of the trade. You just simply close it. Okay guys, so those were the things that I wanted to discuss, and I hope you got some value out of it. And if you like the video, please do subscribe, give thumbs up, and that really motivates me to make more such informational videos. And if you have any other questions, or if you want me to make any other video or any topic that you have doubt, then please do comment below. I will plan to make those videos in future. Happy investing guys, and I'll talk to you in my next video. Bye bye.